Hey everyone, welcome to episode 27 in my monthly series where I present to you my top 3 dividend stock picks in this month's top four, because I have a bonus for on the US stock market this month. So a little bonus for you Americans out there, or if you invest on the US stock market. So these stock picks are all designed for passive income. And in this video, I'll also give you my monthly commentary on how I think or how I see the stock market in the last month. So if you're new to the channel, welcome. I'll go through a few quick reminders before I give you my stock market commentary. So this is definitely not your ordinary stock picks video or investing channel. Let me just start by saying that right off the bat. My investing strategy is quite different from everyone else's, so my stock picks are quite different as well. So there will not be any single stocks, any single companies. I do not invest in single companies anymore. So all the stock picks will be funds, so either ETFs or closed-end funds. And these funds that I pick are all designed to provide high yield and passive income. So they are essentially income oriented, not growth oriented. So many of them have income enhancing strategies like covered calls or leverage. So this channel and my investing style focuses on a long-term buy and hold income focused investing strategy. So the primary objective of the strategy is really to generate relatively safe, consistent, passive income forever. And one important factor of my strategy is to invest consistently and regularly over time. If you invest consistently over time, you could always capture or try to capture what is undervalued in the market, right? So the 5 criteria for my stock picks: number 1, no single stocks, no single companies. I will never invest in a single company ever again, simply because I don't want the anxiety or need the risk. Number 2, I own the fund myself, either directly or indirectly, or plan on owning it in the near future. Number 3, the fund must provide a consistent source of passive income, so a dividend or a distribution. Number 4, the dividend or distribution must be relatively safe and sustainable. In other words, the fund itself should be designed or was created to provide consistent income, even if the share price fluctuates. Covered calls, of course, help to make this a reality. And last but not least, the fund needs to have good value right now. So either because the fund is trading at a discount to its net asset value, or the premium is not as big as it normally is, or the sector or the region that the fund concentrates on is having a bad time right now, is having some hardship, right? Presenting a good opportunity for investors who invest consistently and buy and hold long term. So I'm Canadian, guys, so most of the stocks and funds I talk about on my channel are listed on the Canadian stock market. But since we invest exclusively on the US stock market for our retirement accounts, our RRSP accounts, 1 out of the 3 stock picks in this month's case, 2 out of the 4 stock picks will be a US listed stock pick. So it will be listed on either the New York Stock Exchange or the NASDAQ. So stay with me if you're American, of course, or if you invest on the American stock market. And if you're Canadian, by the way, and you like my US picks, you could always put them in your RRSP. RRSP is a great option because there's no extra withholding taxes. There's none of that 15% withholding tax on the income that's generated from US listed stocks. You have that in the cash account in the TFSA, but the RRSP is immune to that. So if you like those picks, and if you invest like I do only on the US stock market, or predominantly on the US stock market for the RRSP, make sure to put those in your RRSP. Also, guys, don't forget that this is a monthly series, so make sure to check out my previous monthly stock pick videos in case you missed them, as many are still great picks right now. I actually have a specific YouTube playlist with all my stock picks of the month episodes. It's very easy to find them. Click on the name of my channel right there under, and you could click on playlists and you'll find them. And I also took the time to make other playlists, everyone, where I group related videos together, like my portfolio unveil videos, like my investing strategy and philosophy videos. So checking out my playlist is actually a great place to start if you're newer to the channel. So now it's time for my stock market commentary. So Canadian banks have all started reporting really good earnings, which is never really a surprise, right? The financials typically do well during rising rates when the economy is doing well. Plus, the Canadian banks are literally legends. They are the kings of the Canadian stock market. They always outperform the general Canadian stock market. Energy stocks, commodity stocks are also doing well because of inflation. Oil companies, for example, energy companies. So the overall Canadian stock market is doing very well because it's very financials and commodities focused, oil stocks and utilities and stuff like that. It's the almighty US and tech sector that is really the sector that's underperforming right now, and it's the sector to buy or has the most value right now. And my stock picks will definitely reflect that. So I have to say that it was very extremely easy coming up with June's stock picks. I mean, it was literally a no-brainer. Obviously, they will be very tech focused. So although they're not included in this month's stock picks, it's also a great time to invest in crypto if you believe in it, because this stuff is really correlated. I read about 77% correlated to what the NASDAQ does, which is the index that's really suffering right now because it's tech heavy. There's a lot of tech stocks in the NASDAQ. So always remember that, crypto, whether it's Bitcoin or Ether, which are the only two I invest in because it's the two big ones, they're still speculative, they're still volatile assets. So always exercise some caution. And if you feel it's too risky, don't invest in them. As simple as that. My opinion, however, I think I found the safest way in the whole world to invest in Bitcoin or Ether. That would be the BTCY and the ETHY ETFs, which, by the way, they have US versions. They have .u US version. So if you're American and you want to invest in Bitcoin or Ether in the safest way possible, take a look at BTCY.u or ETHY.u because they're US currency denominated of these ETFs. Just remember that they are on the Canadian stock market. So your broker needs to have access to the Canadian stock market or you won't see these symbols. So again, BTCY, ETHY.u. And by the way, I have videos on them, including where I actually talked to the fund manager about them. So don't forget Bitcoin and Ether, the two biggest cryptos out there. You hear rumblings of, these cryptos are crashing and falling. Bitcoin and Ether, I consider them the blue chips of the crypto. And these two ETFs hold Bitcoin, hold Ether, and write monthly covered calls on them. So it generates a nice double digit yield on them. So over 10% yield on these two ETFs. So it's the safest way to own Bitcoin and Ether because at least you're getting paid every month due to covered calls. So you might not understand crypto that well like me, but I definitely understand covered calls, and covered calls equals options premiums, which is equal to yield and monthly passive income. So that pretty much sums up, my investing strategy before. So now it's time to get into the stock picks, guys. Let's go. Top 4 dividend stock picks for the month of June 2022. All right, everyone, it's time for the US stock pick. I'm actually going to have 2 this month as a bonus. I normally do 1. It was probably the easiest stock pick I ever had to do in my life. It should be a no-brainer, no surprise to all of you. QYLD, the NASDAQ 100 covered call ETF. As we know, this is managed by Global X, who is the sister company of Horizons, which is both under Murray Asset Management, actually a company in South Korea. Pretty cool. So the dividend payout is monthly for QYLD. The annual dividend, it's hard to track because the monthly dividend varies every month. So it's about $2.55 a year for per share. So like I say, it's approximate. So QYLD is the biggest by far and most popular covered call ETF on the US market. It's over $6 billion in assets. It completely destroys every other covered call ETF on the US stock market anyway. So it actually holds the NASDAQ 100 index, guys. That's all it is. It's the NASDAQ 100 index. So you have the top 100 companies on the NASDAQ in an index form, excluding financials. There's no financials companies in there. So what do I mean by index form? It means that it's an index. So if the company's the bigger the company is, the more percentage that company will be in the NASDAQ 100. It's not like you're getting 100 companies, 1% each company. So Apple, for example, is like the biggest company on the NASDAQ. So it makes up 13, that one company, although it's only 1 out of 100 companies, makes up like 13% of the whole fund, of the whole ETF, for example. And this fund makes a lot of high monthly income because it writes at the money covered calls on the index itself, not on the individual companies, but on the actual index. They write a at the money covered call on a NASDAQ 100 index every month, and they just do that every single month to generate very, very high yields, like you could see, right? Also, keep in mind, this is not a leveraged fund. It does covered calls. There is no leverage. It's just a regular ETF that does covered calls. Management fee is very, very low. That's why it's very low. There's no leverage. It's only 0.6, which is really, really nice. The 1 year stock price high is 23.15, which would give you a yield of about 11%. But right now, the NASDAQ, which is very tech heavy, has been going down. It's suffering. That's because rates are starting to go up, and usually growth companies tend to not do well during rising rates of rising interest rates. But I think it was a big exaggerated sell-off, just my opinion. So right now it's at 1802. Very, very nice discount from 23.15, and your yield would be approximately 14%. Think of it as 14% interest a year. Really, really, really awesome. Was a no-brainer this month, and might even be a pick, or a good pick, for the next 3 to 6 months, because right now it's a NASDAQ index or the tech sector overall that's not doing well. So here's a little graph. I know it's blown up and you can't really see that well, but I want to show you guys really the performance of QYLD. And if you look on the left side, you see market price. On the right side, you see index. So the index it's comparing it to is literally the NASDAQ 100 index. So basically what this graph is showing, and the first line is 1 year performance, then 3 year, then 5 year, and then since inception. So this fund has been around, I think, for 8 years or something like that. So inception would mean for the last 8 years. So basically what this chart is, guys, is they are comparing QYLD's performance, which is on the left side, market price, to the actual NASDAQ 100 index without covered calls. So QQQ would be a perfect example. So it's literally comparing QYLD, which is NASDAQ 100 with covered calls, to NASDAQ 100 without the covered calls. And typically covered call solutions do have less total return in the long run. That's what covered call solutions do. So you have a lot of income, passive income, but you have a little bit less total return. Total return is stock price increase plus distributions plus dividends. So I found it very interesting because if you look at the inception one, the last line, QYLD on average gives you 8.54% return every year, while the index gives you 9.47. So there is a little, it's not super significant, but it is kind of significant if maximum total return is your preference. But something very interesting happens when you go to the 1 year, the first line. So the performance of QYLD in the last year, you would get 5.43, but the index returns 5.7. So you see that it's narrowing, and it makes sense because in a year where the NASDAQ will go down hard, both QYLD and QQQ will go down, right? Because they still have both the NASDAQ 100 index. But QYLD during a flat or down, or any covered call solution during a flat or a down market, will start outperforming the one without the covered call. Because if the stock market stays flat, which means stock prices stay flat, or they're going down, which means stock prices are going down, your QYLD, your QQQ, both ETFs will go down in price, but QQQ has no dividend, no distribution. QYLD has that distribution. So the distribution kind of makes up for the stock price, and that's the stock price is going down. That's why whenever you look at a covered call ETF, you'll see reduces volatility, because at least you have that income, kind of like a plan B. So in my opinion, I think that the 1 year will keep narrowing if the NASDAQ keeps going down or the NASDAQ keeps staying flat. I think QYLD will outperform QQQ when the market is the NASDAQ stays flat or goes down in price, because like I said, it has the income. So I thought this was a very interesting chart. Of course, you could actually see this right there on the QYLD's website. So I thought it was very interesting. So why am I picking QYLD? Well, this is a no-brainer this month, guys. It's very tech heavy. The NASDAQ index is very tech heavy, had a really bad start to 2022, giving us a great buying opportunity. Like I said in our intro, if you are a buy and hold long-term investor and invest regularly, you want to invest in the stuff that's not doing too well, right? Because that's where the opportunity is. So increasing interest rates typically hits tech companies or growth companies a bit harder because they have higher PE ratios, or price to earnings ratio, and not much dividends. So and lower growth potential is expected, basically, because interest rates are going up. But I have to say that the PE ratios are returning to more attractive levels. You'll hear about that on all the analysts. Companies like Google, Amazon, and Microsoft, the stock prices are going down now, so the PE ratios are going down, which means it's more attractive. So QYLD, which is basically the NASDAQ, although it's tech heavy, don't forget has other sectors. It's not just technology, okay, including some defensive sectors, like as you could see here from the graph, there's 5.5% consumer staples There's almost 6% in healthcare. There's a little bit of utility. So it's not just tech, guys. It's mostly tech. Don't forget that. So owning QYLD is basically owning the NASDAQ with more defense, like I compared earlier, right? It's like owning QQQ, but more defensive or less volatility, which means the beta, there's less beta on it. So beta is just, I'm starting to learn all these terms, which I didn't know, but beta is basically a reference to how volatile something is. So stock prices being volatile. So if the NASDAQ, the overall NASDAQ has a beta value of 1, well, QYLD is 0.66. So it's less volatile. That's actually I found that information in the fact sheet of QYLD, if ever you want to go check it out. And like I say, remember 2020, guys, financials, energy, real estate crashed, but tech took off. Now the opposite is happening, right? So in 2 years, the opposite could happen again. So this is how I generally view the stock market, and it's just the economy as a whole. So if you're a diversified investor, that you have everything, you understand that certain sectors will do good at certain times and go down at certain times, and then others will make it up. So as long as you're diversified, you're good for the long term. That's why, like I say in my last point, I repeat, it's best to own everything, invest regularly, and opportunistically for the long term. All right, so before I go into my pick number 2, which is my first Canadian pick, I want to give you a bonus US pick. So I don't do this normally often, but I decided it would be a good idea to do it this month. And the reason is, QYLD, is a NASDAQ 100. On the Canadian stock market, you'll see that in pick number 3, there's a lot of specific only technology covered call ETFs. There's quite a few of them, and QYLD is tech heavy, but it's not specifically technology. So are there any other covered call options out there besides QYLD if I want to capitalize on technology sector? And I did find one from BlackRock called BIGZ, BIGZ. It's called the BlackRock Innovation and Growth Trust, and in here you have primarily companies that they feel, first of all, they focus on mid and small cap growth companies, which are smaller companies, smaller cap companies. So Apple, Microsoft, Amazon, these are big cap. Smaller caps are smaller companies, basically. They have less value, or AUM, it's not AUM, but market cap. So these guys, this is a portfolio of growth stocks. So there's a lot of technology companies in here. As soon as you see innovation, growth, you'll have a lot of technology companies, and they describe, that they're choosing ones that they feel are innovative. And what's cool about this is the trust utilizes an option writing selling strategy, which is basically covered calls, fancy word for covered calls, in an effort to generate current gains from option premiums and to enhance the trust risk-adjusted return. So this is a covered call ETF, guys. Well, it's actually technically a closed-end fund. It's not an ETF, so it's a covered call closed-end fund. And why I think it's a great pickup is because this has completely crashed by a lot in the last 6 months, because it's very, very technology heavy and has a lot more speculative growth companies. But why is it a pick of the month? Because it's trading at a big discount right now. So it's oversold, in my opinion. It's an exaggerated sell-off. And what does that mean? It means that the value of the fund, the actual how much this fund is worth, is $10.41 a share, but you could invest in it on the stock market. You could buy it now for $8.76. So when the market price on a closed-end fund is a lot lower, in this case 16% lower than the actual value, it means you're automatically getting a good deal on the stock. You're buying something at a discount. It's literally in the name, right? So I thought that was very interesting. That's number 1, the big discount. Number 2, the big dividend rate, 13.7%, guys. How's that for a dividend? Really, really good. You could, go on the website and look at this fund in detail. Hasn't been out long. It's been out since June 2021, and the distribution is never changed at 10 cents a month. Now, I'm not saying it's going to be 10 cents a month going forward forever. All I could tell you is they still haven't changed it to 10 cents, changed or lowered it. It's still remaining 10 cents. So very, very, very high yield, very nice consistency. It's monthly income. It's on the US stock market. You cannot pay attention to the annual performance since inception. You'll see minus 30%, 39%. That's because it's only been out for a year or two, and it's all tech stuff. So you could actually click on holdings and look at more details on what kind of stocks it has. It's mostly United States. If you go to market cap, you'll see that the majority of the fund is in smaller to medium-sized companies. But there's still some big caps in here, bigger than 10 billion. If you click on sector, you'll see there's a lot of software, consumer. So it's not only technology, but it's primarily technology. But there's other cool stuff like pharma, healthcare, food, beverage, and tobacco. I'm assuming that's probably going to be some cannabis companies in there. So anything innovative, right? So I thought this was another cool option to give you guys. I'm planning on making a video on this specific closed-end fund and other BlackRock closed-end funds, because I just discovered this fund manager. They have some really cool options on the US stock market. So getting back to our stock picks, that was the bonus pick. So now let's go with the pick number 2 technically, or my first Canadian stock pick. It's HDIF. So this is the Harvest Diversified Monthly Income ETF. It's one of the 3 all-in-one covered call ETFs that exist, that are out, that I absolutely love from Harvest. So it's managed by them. The annual dividends, 85 cents a share annually. The dividend payout is monthly. So HDIF is an all-in-one covered call solution. It holds 5. So it's an ETF that holds 5 other ETFs, 5 other covered call ETFs. Really, really cool. So the exposure in total is primarily the US stock market, which is very tech heavy. And this ETF, like the other other all-in-one covered call ETFs from Hamilton, use 25% leverage to enhance the yield of returns. I should have put 25%, but I didn't put it here. Interesting fact: this ETF has no management fee, 0% management fee, because the ETFs inside of it are all Harvest ETFs. So the 1-year high can't really gather much from that because it hasn't been out. It's only been out for about 4 months. 1035, you get a yield of 821. Right now, it's a great little discount at 940. You would get a yield of about 9%, which is really, really good. So why is this a pick? Well, the US market and especially tech has gone down recently. HDIF is a great way to capitalize it because it focuses on the US market. You have automatic diversification with one ETF. It's not only tech. You can see the 5 ETFs that are in here. So you have the equal weight global utilities. So it's an ETF that holds just defensive utilities companies. HHL is in here. So you have the healthcare one, the brands one, and then there's one out of the 5 ETFs, the tech achievers and growth, which is just tech companies. And you also have US banks. So it's very, very well diversified, but it is a little bit more tech heavy or US focused. High yield of over 9%. It's a regular ETF, so you don't have the structure and the risk of a split fund. So missing dividends. The split funds have a lot higher fees. So it's a good option if you want the attributes of a split fund: high yield, covered calls, leverage without the risks or the higher fees. HUTL and HHL, which are the first 2 ETFs on the side there, are very, very, as well as some companies in their HBF or the brands ETF, which is the third one, very defensive, right? To provide some great defense in here. So you not only have technology, but you have defense as well, healthcare and utilities, which helps keep the fund nice and stable, lowers your volatility. So it's very, very similar, to be honest. This ETF is very similar to another one of my favorite all-in-one covered call ETFs, which was in the stock picks of the month from last month, HYLD. So HYLD is still a good pick, guys. If you're saying, well, why did you pick HDIF over HYLD? Well, last month somebody told me why not HDIF? Well, they're very similar. They have a very big tech exposure. They're both great. HYLD is still a great pickup right now. Okay, but this one, the biggest difference is that it has a little bit more defense, a little bit more defensive than HYLD. 20% of the fund is also US banks, something that's very underrepresented in Canadian portfolios. We're typically very, very heavy on Canadian banks. So this is a cool way to get some US banks exposure here very safely because it's indirect exposure. It's only 20% of the fund. Again, 0% management fee, definitely a strong point because all the ETFs within are their own ETFs, and 25% leverage, which is very modest. So they take out a loan facility, they borrow money on the fund to basically at a very low interest rate, by the way, because they're an institution, to buy more shares. So it increases basically your yield and your returns long-term by 25%. Pick number 3, or the last Canadian pick, I did something different this time. It's not really a specific pick, but you have 4 choices, basically. We're spoiled for choice. So the last pick is a pure or a specific technology covered call ETF. So in Canada, we have 4 of them. And I listed the 4 here. They've been 3 out of the 4. So the first 3 have been around for quite a long time. So you could actually get some good information if you look at the annual compound returns on average by year. So first you have probably the most popular one, the TXF from CI. So that's the highest yielding option you have. It's about 10-11% yield right now. It's only technology companies, and it's only the big cap technology companies. So Apple, Microsoft, Nvidia, AMD, Cisco, etc., etc. It does have quarterly and varying distributions. That's kind of a bit the annoying part of all the CI covered call ETFs, including TXF. So it's not monthly dividends or monthly distributions, sorry, it's quarterly distributions, and they could change every quarter. So it's a bit harder to track your income, but still the highest yielding option. It's been around since 2011, and on average, it gives you 13.8 average compound annual return. So very, very nice. Harvest, so the stock symbol HTA, has about a little bit lower yield at about 8.5% yield, but the distributions are more consistent. They're monthly. They recently increased the distributions by a whopping 30%. I spoke with Michael Kovacs about it in an interview I did with him also on the channel. It's been around since 2015, and the average compound total return is 14.06. So it slightly beats TXF in terms of annual compound return, but it's came out 4 years after. So take that with a grain of salt. They're pretty much neck and neck in my opinion. So Brompton also has one called TLF. This one has the lowest yield, but they're monthly distributions, and they actually also recently increased their distributions by 25%. It's been around like TXF since 2011, but the average compound total return is a little bit less at 12.4. BMO just came, the most recent one that came out in 2021 is BMO's ZWT. So in there you have about 6% yield, monthly distributions. We know that BMO likes more consistency. It's a bit more conservative. They don't want to pay out too much. So here are your 4 choices, guys. If ever you want an option that's pure technology, that's only technology, these are the 4 options you have. They are all 4 covered call technology ETFs. And in my opinion, I could just give you my opinion. If you're looking for the highest yield, you're going to go with TXF. If you're looking for the highest consistency and monthly income is more important to you, that consistency, you could go with HTA, except you're getting a little bit lower yield. So key points and reasoning, again, I'm not going to repeat myself that much. Clearly the undervalued sector right now. The covered call strategy gives you high income with less risk than owning a tech ETF or technology companies without the covered call, right? Because if you just own the technology companies, most of which don't give you dividends, if the market goes down and your stock price goes down, that's it. You have no plan B, right? So the covered call options give you a plan B. They make you happy to wait because you're getting paid every month or every quarter. So all 4 of these ETFs never miss the dividend. You're owning the best blue chip technology companies with one ETF. And don't forget, guys, that HTA, which is the Harvest one, is already in HDIV and HDIV. HDIV is the Hamilton covered all-in-one covered call ETF, and TXF. Both TXF and QYLD are in HYLD, right? So just remember that. So these 4 are specific, they're what I call pure technology ETFs, but you could get some indirect and heavy technology exposure either with HDIV or HYLD. And on the US market, it would be definitely QYLD. It's literally the NASDAQ. And I gave you that other bonus option big. So these are the stock picks of the month for June. It was really a no-brainer for me. Technology. That's what's undervalued right now. Will it be undervalued for the next couple of months? I think so. Will it be undervalued in 2 years? I don't know. So this is why we do take the opportunity to invest a little bit more in technology now. That's for sure. So there you have it, guys. Those are the picks. Thanks for watching, everyone. Really appreciate it. Please show your appreciation by hitting that like button. It's free for you. It takes 2 seconds. It helps the channel grow. It helps get the message out. So it's a win-win. Also, if you like this type of content and you're not subscribed yet, make sure you subscribe. Hit that little bell button so you're notified of any upcoming videos. You don't want to miss them. And make sure to check out our website, passiveincomeinvesting.ca. That is where you could access a bunch of free tools and resources. You could download my portfolio, my monthly stock pick report card as well. And of course, that is where I offer my digital product that I'm very proud of, the ultimate DIY investing package, which is on version 3 right now. You only have to buy it once. It comes with lifetime updates. My plan is to do an update at least annually. So version 4 is scheduled to be released in Q3 of 2022. So stay tuned. It's going to be a really, really cool update. So this product is really to help you build your own portfolio, no matter what your investing goals are. So it's not just tailored for income investors, but there's also sample portfolios, for example, for growth, for dividend growth and income as well. So it's a really, really cool product. It's really designed to save you time on research, of all the all the crazy great funds there are out there. There's so many of them, so many ETFs out there. So this product will help you think of it kind of like a reference tool or reference guide to help you build your own portfolio. I also offer a one-on-one coaching session. It's right there on the homepage if ever you need more personal one-on-one touch, where you could ask me all the questions you want and I could assist you best I can. Keep in mind though, this is not a financial advice or financial planning session, because I am not a certified or a registered financial planner. This is just a regular lifestyle coaching session where you could ask me all the questions you want and I give you my opinion based on personal experience. Also, we have a Facebook page, over 11,000 members now. We are very, very strict about letting people in. We try to get rid of the scammers and bots right away. So it's a very, very cool group where everyone is sharing their experiences, asking questions. So make sure to join us there. Passive Income Investing is the Facebook group name. We're also on Instagram. We don't use it much, but we plan on putting more personalized stuff on Instagram. So make sure you follow us if you want a little bit more personal stuff on our everyday life. So once again, the mission of this channel, well, my mission will always be the same. It's to help ordinary, regular, working people invest on their own. Do-it-yourself investing in order to build your own stream of passive income, to enhance your quality of life and become financially independent, to become financially free. So as usual, stay safe, stay healthy, and of course, stay passive. See you next time.